All right, Julie, it's been a great show so far, but I got to ask, we've had two different perspectives. We had one who believed that the cycle is rolling over. By the way, I still find it hard to believe that this recovery is going to go on very short. I mean, Jared said it best that we had just started and it's a regulatory crackdown, and I think that's why tender rejections are on fire.
I think we heard it in every tender rejections. I think we heard it in every earnings call. Every executive said we're in the early innings of this.
I agree with that.
We're just starting to reap the benefits of it.
Do we think our first guest was just, he was talking about the global economy? And I feel like
isn't going to pick up. But I don't think that brings capacity back into the market.
I think you've got this long-term cycle. Look, we're at 13.5%, is where we're at today. We're well above where we have been, certainly year over year. This is a soft season. I think Jared said it best, this is kind of a time of year when things are naturally soft. And look, we have a lot of opportunity for momentum going into the second half or going into September past Labor Day. Anything that you really are thinking about or watching?
No, I mean, I just think that we need to continue to, I think people are a little bit worried about this bit of a downtick, even though it is
But
seasonal.
Look at where we were
and then I think you need to remember where we've been the last 3 years, and then you feel better about everything. Right.
I was not used to having nice things. It feels like a little bit of a party, maybe a little bit of a hangover, got a headache. We're going to go back and party again, right? Don't you think?
And I think the same with spot rates.
Spot rates. Spot rates follow tender rejections. We've seen this. Peaked. We're at 13.3. Remember, if we were here, go back a year ago. Look at where we were a year ago in that 240-ish range, 240, 250. We would have murdered for that, right?
Absolutely.
So why is everyone not feeling
it's all that point of reference,
momentum,
when you walk out of the door. If we went outside tomorrow and it was 80 degrees, we'd be like, oh, this is beautiful. It's wonderful compared to
the heat index.
But if you went outside and it was 80 degrees on April 1st and it had been 65 the day before, you'd be like,
even
it's
45,
hot.
You'd be like,
oh my gosh, it's so hot. I think it's all that point of reference, right?
We got and I think
really spoiled for a little bit, and
I think we all wanted it to continue to go up. Right, we all wanted it to continue.
It's going to have to normalize. That doesn't mean it's going to fall, right?
Because point of reference. But to your point, there's nothing to really suggest that this market is capacity is not coming back. I mean, a 20 to 25%. We didn't get into deep with Jared, but a 20 to 25% change in capacity is massive.
That's the largest number I've heard on that.
But by the way, John Kingston, our energy reporter, who studied the commodity markets his whole life, has talked about it's the incremental barrel of oil that sets the price. And it's just like in trucking, it's the incremental. Travis Kalanick, to quote him, it's all about pricing, right? Strategy and transportation is all about pricing. And I think what we're seeing is that pricing is going to continue. Pricing will find a way. And so when you have a 20 to 25% reduction in capacity, if Jared's correct,
and a 26% increase in operating costs,
then you're going to see a massive inflationary market in rate and massive continuation of tender rejections happening. It's inevitable at that level. People get caught up in hey, I'm reducing 20% capacity, therefore rates must go at 20%. No. It's not that simple. Because shippers will pay whatever.
Well, it's not cost
the price bears,
right? That's what. And I know I'm talking about trucking costs going up 26%. I am fully aware that a regular out one-way trucking is not cost based, but I think some of the regulation is driving that carriers have to be profitable in order to be able to continue to invest in safety and following the regulation and hiring the right kind of drivers.
I think in every industry where you have gone from a deregulatory environment to a regulated environment, when the pendulum starts to swing towards regulation, it doesn't stop because no one wants to go back to the free for all. They want to go back. They don't want to go back to anarchy. And you could describe the trucking conditions as anarchy over the last couple of years. We're now headed into more regulation. I feel like it's going to stay. I don't believe or subscribe to the argument that Ken Adamo made yesterday that this is somehow going to stop. I think it's going to stay. I think it's going to continue to consolidate. I think the regulations are real. They happen at the state level. They happen at the federal level. I've met Derek Bars. We interviewed him in studio. He is hell-bent on doing police enforcement on regulate, putting more regulations that are sustainable in this industry.
Yeah. All right, so let's talk a little bit about maritime. We can go through this sort of quickly, but really the story here is that ocean rates are rising.
Look at this.
So the
3,000
blue line
to 7,300
is from China to the U.S. West Coast. The white line is to the East Coast. So you can see the
9,400 to the East Coast.
Massive increase in spot rates. But the reason I wanted to talk about this today,
by the way,
ocean spot
rates.
rates.
These are TEUs, 20-foot equivalents.
And the reason that I wanted to bring this up is because I think this is another example, sort of like what we talked about yesterday, where context matters. The rest of the data that we can provide in SONAR beyond just the rate really explains the story of what's happening. So while these spot rates are up, demand is not. Volumes are not. So if you compare the IOTI China to the US, you can see that the volumes have not gone up.
Down 1%.
So demand is, like in the trucking market, demand is not what has driven this increase in
the ocean carriers. I think a couple of things are going to happen there. It's a very concentrated market. The top 10 carriers have 90% market share.
Yep.
They have done a number of blank sailings, which means they basically cancel voyages. They slow the ships. One of the classic things that they do is slow the sailing. So it's not being driven by volume, but it's being driven by the ocean containers have an enormous amount of pricing power. And like I've said this before, and I'll say it again, is no crisis left untouched. They use the opportunities, whether we're talking Hormuz, whether we're talking the Suez, whether we're talking, all of the different things that happen around international ocean shipping. Container liners are always willing to take advantage of those opportunities with higher spot rates.
So while it's not fragmented like trucking, the supply side chaos is driving the pricing, like I feel like in the trucking market.
Well, they're able.
You can see demand's not up, rates are up. You zoom in and you look at it just the last month.
I wouldn't call it chaos.
There's a bit of chaos.
It's the opposite of chaos, Julie, in the sense that this is very orderly. The ocean container lines, if you go back into the 2016, when Hanjin failed and went under, spot rates were $800. The ocean container lines had no pricing power, none. They lost it, but what they realized is, hey, we shouldn't be fighting each other ruthlessly for market share. We should be trying to maintain price, and the profitability's followed, and that's exactly what we're saying. So I don't think it's chaos. I think for shippers, it may feel like chaos.
I think for shippers, it feels like chaos. And I think that they are going to your point, no crisis unused to raise rates. So they can speak to, so this is the last month where you can see inbound to the East Coast, inbound to the West Coast in demand, when you just really see
demand out of China down 6%.
Demand is down, but when you look at those rates just since early August into the West Coast, massive increase specifically into the West Coast.
Yeah, I mean, look, a lot of this is just,
part of it is ocean containers, the providers can do it.
Yep.
Part of it is there are some, we don't need to talk about rejection rates. There's some factors that are leading to this that they could take advantage of, right? There are this El Nino. The Pacific Ocean is warmer than usual, more typhoon activity than normal. The Atlantic is cooler, less hurricane activity, but it's also been very dry. So the Panama Canal is a little bit low. So they have all of these reasons to be able to raise rates.
But no crisis left untouched. That's what the ocean container lines do. Crazy stat. If you go back, so everyone agrees that OPEC is a cartel. OPEC combined, this is before we saw the recent, the UAE and others sort of leave OPEC, control about 36% of global oil supplies. Enormous amount of pricing power. The ocean container lines, the top 10, controlled 90%. Here's the crazy stat. I always have said this, I'll say it again, is the ocean container lines are not subject to U.S. antitrust. So they can and they can coordinate schedules. That's entirely legal. And what they'll do, very much like OPEC, OPEC pulls barrels off the market to control price, or puts barrels on the market to allow for prices to come down. The same thing, the ocean container lines, they pull capacity out of the market, rates go up. So while they may not be collaborating on price, they're actually collaborating on capacity in ways that give them pricing power. And that is really important. And I think it's why you see U.S. consumers and U.S. businesses having to pay really high container rates.
Yep. So we can run through these, but the overall point, rejections not super relevant. The percentages of what's being rejected is not high compared to prior years, even though these rates are going up. But we are seeing more port delays. They're blaming it on these weather and all of those things. And I always like to try to put something here to provide context beyond just what shows in Sonar. So Yangming came out with their earnings yesterday, and it really talks about a lot of the same things we just saw in the Sonar data, with those spot rates being up, an early peak season, firmer freight rates, and they even spoke
Look at
to
482%, which is why they
crazy
like
rates up.
higher prices.
Well, of course they do.
And it's no longer about he who has the most ships win. It's who has the highest profitability. That's what investors want to see, and that's what they're doing. That's why we have these surging spot rates.
Absolutely. And then they're going to, no crisis averted, talk about all of the things: trade policy uncertainty, geopolitical disruption, the Red Sea, excess vessel supply. They are talking about how more capacity is going to be added than demand. They believe. They did state that in their earnings. And schedule reliability. So I think the bottom line here is that if I were a shipper and I was trying to plan for fourth quarter, I would expect some volatility, certainly in rates, but potentially in capacity as well.